All right, guys. Let me go ahead and all right, guys. So lots has happened. There's I think the elections are getting extremely interesting. Uh, Before we even get into that, first and foremost, thank you guys for joining me on my channel, Snowball Hustle. My channel is pretty much my journey into options. I've been trading options now for over 5 years. I've been in the market for 15 to 20 years. My professional job, if you will, is to sell commercial real estate. And so when I discovered selling options, I dove right in, and I've learned a few things along the way, which is what I hope to share with you all. The point of this account is really to slowly grow it, minimize risk, but also maximize premiums and profits. There's a fine balance, and option trading is sort of like riding a bicycle. The idea, you can't study how to ride a bicycle. You have to just do it, and you get better as the more you ride it, and you develop a sixth sense. What is balance? How do you explain balance? It's almost the same way with options. So to get right into it, we try to keep these under 30 minutes. People have things to do. I have things to do. And so let's go ahead and just jump right in. This account is very heavily invested in Tesla. I will go over all my positions. I will go through a few of the positions on how I track them on my Excel. It is probably the most important thing to do is to track your trades and think of your portfolio as a wall of bricks. And your goal should be to place small bricks, small trades, best as you can, maximize profits on each brick. And your portfolio is therefore then the wall of bricks. But don't try to, create half the wall with one trade. That's not the right way to do it. So I'll go through a few of my smaller trades, larger trades. We'll also be touching on a few trading rules that I've kind of written along the way, things to just keep in mind. They may mean nothing to you. Forget them. If they mean something, I'm happy for you. I'm glad it worked for you as well. And then lastly, we'll do a Q&A. Any comments that I see on YouTube or on Twitter, I'm going to go ahead and answer them, whether it's a position that you want to go over, whether it's a specific thing on truly understanding, not just memorizing buttons, but understanding options is probably the most important thing. Any questions related to that as well. So having said that, let's go ahead and dive in. So we're at 230. We look at the year-to-date performance. Just to do a quick recap, we're closing in on 60% returns, close to $84,000. Let's go ahead and talk about each trade, right? So one of the main things to keep in mind when you're trading is, I personally don't like the style of, investing in 15, 20, 25 companies. There's people that do that. They claim it's diversifying. To a certain point, they're correct, but I'm a true believer that you begin to understand how a stock trades. Stocks have certain, systems or certain, what's the word that I'm looking for? Pretty much they react the same way to certain events, whether it's earnings, whether it's based on Bitcoin. And so when you track a stock for a certain amount of period of time, and you truly understand how, what ranges it's trading in, it's a lot different than reading the chart, completely different. And so that's why I'm a firm believer in picking 4, 5, 6, 7 maximum stocks. that you truly go all in on, and those become your main assets. And you have to look at your shares as assets, because when you wheel them, you're essentially creating cash flow from the assets. It's sort of like, and I love the analogy that TJ uses, it's sort of like riding a bicycle. It's sort of like buying real estate. You buy a duplex, which is, let's say, 200 shares. And now the tenants, each contract is paying you a premium, but you still have the underlying asset, right? And the idea is that that asset goes up. So having said that, I'm going to talk a little bit about each individual one, what I think about it, and we'll go ahead and see. So CleanSpark is one of the Bitcoin miners. I primarily like CleanSpark and Riot, though I am truthfully not very involved in this space. I follow a few accounts that are. What I don't like about CleanSpark is their constant dilution, and I think they just had some sort of announcement as well that I believe they're getting ready for a second dilution or some sort. Long story short, they're down about 1130. Now, I want you to see how options have sort of gotten me out of this pickle that I'm in with CleanSpark. Because what you don't see on CleanSpark is my average cost, and I'm not a fan of the way that Robinhood kind of calculates it. The way I like to calculate it is I like to know what my average cost is on the stock itself, right? So if I sell shares at a loss, technically my basis goes up, right? But I don't believe Robinhood does it like this. If you sell it at a loss, it just counts it at a loss, but then it just divides what you've invested by the number of shares. So I'll show you my tracker. It's a little bit different than this 1209. I wish it was 1209. I was selling puts on CleanSpark, right? So let's go ahead and dive into the Excel. So this is what I use, and if anybody wants a copy of this Excel, I'm more than happy to give you one. Pretty much I cover the stock here at the bottom. So this is where I track the individual stock. Pretty much, if I go to the top here, let me zoom in. We've got the date we opened it, what we did with it, the expiration. I try to keep it very simple. What your strike was, your number of contracts, your premium for that contract. This multiplies it by the number of contracts. This tells you which trades are open, which ones are closed. This shows you the date that you closed it and what your eventual profit was, and then your ROI based on the amount of collateral or the value of the shares. So that's pretty much, and then if you see that yellowish, it's pretty much just a put. I like to see which ones are the puts and which ones are calls. And so right here on the green, we have the total amount of profit that we've generated from that individual stock, right? It takes into account the losses and takes into account the everything. I don't know why there's a plus 240 in there somewhere. Let's go ahead and take that off. And so here you see what my shares were, right? And the reason why my cost basis is so much higher is because if I sold a put, for example, right, which is how I eventually got into this position, I was selling $17.50 puts. This is when CleanSpark was trading at $18, $19, right? And I generated a good amount of cash from it. I'm looking at $2,500. So even though I collected $700, $1,400 worth of premium, the way I book it here is as in I bought at $17.50 because I really like to keep the premium and the stock separate. So here, I put here, I bought 700 at 17.50 because I really like to see, and then the at the end of the day, I think it all shakes out to the same thing. I'm just counting it different. But at here, I take the profit from the premiums, right, which is this number right here, and then it gives me my adjusted basis, which is 1264, right? So it says I have 500 shares that I bought at 1980, but I've generated 35.80. So technically my premium is $12.64, right? So 12.64, I believe it's at 11.39 now. So close to $100. So I'm down like $500, if you will. I really want to get out of CleanSpark. I do think Riot is probably the superior Bitcoin miner. I had a very cool conversation, and I got to meet Christian Options and TJ the Wheel Deal, and it was phenomenal. Meeting people from X in real life is such a cool experience. It almost feels like you've been friends already, but you just haven't seen them in a while. it's a very cool experience. And so we got to talk, and TJ had just attended a roundtable at Riot. And so he was very able to tell us sort of what their game plan was, and help us analyze Riot a bit better. And so I understood Riot, and I like Riot a lot more than CleanSpark. So I'm really just trying to get out of CleanSpark, right? So what we see here is that I have a few positions open on CleanSpark. Basically, I'm just wheeling the 500 shares that I have, right? So I sold $12 calls for November 1st, and then I sold one call for the 8th, and I have 100 shares disposable that I haven't sold a call on. That's because that expired on Friday. It's currently Sunday right now, so the market's closed. So I'll probably wait for a green day and then sell a call on that as well. I'm gonna just sell calls above $12. That's sort of my goal. Sell them above $12. $12.50. My cost base is $12.64, $12.65. I'm okay with that. It did pretty good. I mean, look, it was already up to $12.23. So I it fluctuates a lot based on Bitcoin. So if Bitcoin has a good reaction after the election, I think we'll be able to see $12.50, $13 easily. So that's pretty much it on CleanSpark. I have these $12 calls that, I sold for $77, but a lot of these are rolls. I had to roll them out, so let's zoom in on this here. This is how I track my rolls, because when you're rolling, you have to keep track of whether you got a credit or a debit on the original one, because it's still part of the trade when you roll, right? At least I like to consider it that way, because I hate losses. So I had originally, for example, on this square here that you see, because this is a roll, these two are paired together, I had sold a 1050 that expired on the 18th, on October 18th. So last week, it was obviously above 1050. So I said, you know what, I'm going to roll it out. So I actually closed it for a $112 loss, negative 10% on my basis. X signifies it's a roll. I rolled it to $12. So I gained close to $150 in capital appreciation. And I was actually able to close it for a credit. So I made about, so when this shakes out and this expires under $12, I'll pretty much just be at a $37 profit. So I'll still be at a profit. It'll just be $37 plus $150 of capital appreciation on the shares, right? So that's pretty much it. I've got 150, I've got 178, and hopefully these two puts expire out of the money. I've got close to $800, $828 coming in, right? So if I was to look at my adjusted basis and I add the $828, you're looking at an adjusted basis of $11. So if everything pans out by that date and I'm above, and the shares are above $11, I usually do two things. Either I completely just sell it off, right? Just completely sell it. Or, depending on what's going on, I'll sell it in the money. So I basically don't partake in any of the appreciation. I lock in a certain price. So if it goes lower in the next week, I pretty much already locked in my sale price. So we'll cross that bridge when we get there. But that's pretty much the scenario on CleanSpark. It's not a big position. You're looking at a $10,000 position. That's pretty much what my basis was on it. So it's not, and I've reduced that basis now to what's that? 500 times 11. I've reduced it to 5,500. So pretty much half of it. Okay, so now let's go back to positions here. So Intuit, let's get into Intuit. Intuit was pretty much an experiment into long dated call, poor man coverage call. That's it. The poor man cover call strategy. What is a poor man coverage call strategy? It's a strategy where you buy a long dated option, so a leap, usually at or in the money. And then you sell short dated calls against it. So you're essentially controlling, you're paying a fee to control 100 shares, and then you sell calls on those 100 shares. The challenge there is it's twofold. Number one, your calls can never be assigned, or they can be, but you can't do it too early, because on all the premium that you paid for the long dated call, which is a mix of two things. It's a mix of the actual stock value, but it's also time. You paid for time. You paid for 3 months worth. It's like you rent a car for a year, but you return it a weekend and don't ask for a refund. That's pretty much what getting your long dated call feels like. You know, you paid for all this premium for all this time, but you let it get assigned early, you lose there. So the goal is to be close enough to where the stock price is to generate a decent premium, but far enough so that you don't get caught underwater and get them called too soon, right? That's the game. At the same time, if the stock price itself goes down too heavily, then the value of your long dated calls, because they still hold value for all the remaining time, but the value of the stock of the long dated option loses value, because now the stock is way below the strike that you bought it at, right? So that's pretty much the game that I was playing with Intuit. I wanted to try this strategy. I've been dabbling in it. I know TJ the Wheels really utilizes this strategy. I wanted to utilize it heavily with Intuit. And so pretty much the play that we have here with Intuit is the following. And this is how I keep track of it, right? It looks like a lot, but it's really not. Up here in purple, we have the calls that we bought. So these are the long dated ones. I had chosen a 690 strike. A few of them expired last week, and then the remaining tranche of 5 expire in December. So I've got about 2 months left on them. I've sold one for 600. The other expired worthless. These are the actual positions. So these are the calls, the short dated ones. I've sold against these. So these cost me a total of $17,745. That's how much money I spent buying those calls. On the contrary, I've generated, and we can look at this little window here. So total contract cost, this is what we just saw, $17,745. That's what we paid. Current value is what are they worth today, right? And that's what I was talking about when if the price of the stock goes too far down or it corrects too strongly, then the value of these 690 1220s are going to go down because you're getting further away from the 690, right? Now, obviously, I had bought these a little bit out of the money, but now they're very out of the money. So the value has sort of plummeted, right? Which is not good because you're buying basically assets. It's like you're buying a car to give Uber rides in, but then it turns out that the car loses value, so you can take less further and further trips. You can only take shorter and shorter trips. You know, like your car is losing value. So right now they're currently worth about $610, right? So let's go ahead and update that right here. $610. So they're worth about $3,000. 5, 6, 7, 8, 9. Yeah, 9, 4. Because I sold one. I used to have 6. So we have about $3,000 in assets, or the long calls that I like to call. Premium generated. So we've generated a pretty decent amount of premium. You know, we've generated close to $20,000 in premium, right? So we've already paid for our total contract cost, right? So we are basically green right now. So we've generated 19,000. They're worth about 3,000 still. Pending premium is the premium we have expiring with the calls that we have out right now. And you'll see that we only have 2. So I still have 3 in the arsenal that I can deploy on Monday when it turns green and bring in even more cash through the door. So we'll go back here. We have 660 pending premium, which, look, just for the sake of the exercise, I usually can generate close to $100 to $150 worth of premium if per week, being very conservative, low delta. Let's assume I can get those 3 contracts at 100, right? So we're adding $300 to the premium pending, right? So we got close to $1,000 coming in. This puts our profit at $5,690, right? And I'm basing that off of our profit or loss. I'm basing that off of our initial cost, which was $17,745. That's what we initially spent. So we spent $17,000. I bought a car, and I've generated $19,000 in premium, close to $20,000. So that's 32%, right? So doing pretty good on this. Once you reach the point of having covered your car, if you per se, or you paid off the homes, you're basically at zero. It becomes easier to justify keeping them, because why would I sell them at 600 if I can generate close to $100 to $200 a week on them, and I have 8, 9, 10 weeks? I can generate more than the value of the contract. There is one rule that I have to look into, and I'd appreciate it if anybody knows about this rule or the math behind it. But I believe it was Tasty Trades that covered it. But they basically advise you to close a long-dated option 21 days before expiration, because something to do with the curve of theta. So if you look at a graph that shows how theta decays, it accelerates near the end. So I'm assuming that 21 days is that period where it really starts to accelerate. So 21 days before December 12th is November 30th. So around November 30th is when I'm going to make the decision whether to sell these at whatever cost, whatever value they're worth, or keep wheeling. And we'll cross that bridge when we're there. But this trade right now, we're currently at about 30% profit. And look, this was started 822. 822. So that's 822, 922, 1022. So it's really been 2 months. 30% for 2 months is pretty good. Not bad at all, considering the stock went to 610, 605. Now, some peripheral trades that I do have, which are down here. These are just things that are not due to the wheel. I had sold the credit spread that I was able to generate about a $350 profit on the put that I had bought. So I sold the put, but since the credit spread consists of selling a put and buying a put, I sold the one that I had bought for a profit, but I kept the put because it was underwater, and I just rolled it from a 630 to 620, right? I closed it for $1,000 loss, but I generated $2,195 in profit. So essentially, if it's above 620 by November 8th, I make the $2,195, but I've taken that $1,000 loss. So I make $1,000, $1,173. So that's a little kind of bad trade that I'm stuck in. I'm not concerned. Intuit has held the resistance at around 605. It hasn't crossed that at all. If it does cross 600, I'll very seriously consider just closing everything. But right now, it's holding its ground very well. So I'm not concerned. Their earnings were actually very surprisingly performed very well, their last earnings, and I think we'll continue to see that. So this is another $1,000 that we could generate here. These are previous. I had previously generated $1,400 in put sold. So this play has been pretty good. So when we go to Intuit here, you can see the calls that I had sold, the put that I bought. So I bought this put just to account for to free up some collateral on my 620 put, right? Because if you have a 620 put, Robinhood's going to require $62,000 of margin or of cash secured puts. It's a cash secured put, so they want the cash. That's $62,000. But if I buy a 510 put that expires on the same date, I'm basically telling Robinhood, look, I'm paying to control $510 puts. So that means $51,000 is covered by the put, which means that the collateral requirement is just the difference between the two, which is close to $110. So about $11,000 of margin as opposed to 62, right? So just something to keep in mind. Now this put, surprisingly, has it gone up in value? It has gone up in value. It's up to $135. So, I can also, if I really wanted to, I'm not using that much margin. I do have the margin available. I could just sell that that put, let margin fill in that space, and then I have to be confident that it's going to continue to go up, though. So maybe that's something we will do. But that's pretty much it with Intuit. I don't really pay attention to the value here of Intuit here where it says total return, because it is booking a pretty, if I go on my calls, it's not necessarily a loss, but they have lost a lot of money, right? So that's $10,000 done down. But we know that's expected, but that's why I don't pay attention to it. So let's go now to Intuit, Riot. So look, Riot, another one of those mining companies, probably the best ran team, most impressive executive team. Stock's at $9.50. It fluctuates pretty heavily. I've been doing phenomenal with this trade, mainly because I don't own any shares. And honestly, I sort of regret it. I should have bought it around $6, $7, but I've generated enough selling puts that I can't complain. Let's go to all my Riot puts. So I have 10 $8.50 puts that expire November 1st. Right? I sold these, I think, when they were like at $8. Right? This was sold on the 10/17. So this was sold 10 days ago. Sold them for 30. So I've generated about $180. Not bad. $9 puts for the same. Average credit 20. You see, so I may actually increase, depending on what happens with Riot. I may actually increase these. This is actually a pretty decent trade. $9 puts for, you get 25 cents of premium. Do they have earnings coming up? Is that what it is? Let me see. Something I probably should have checked before October 30th. Oh, wow. Yeah, that's exactly why it is. That's exactly why we have that. So I don't know. I may just leave it as it is. I don't want to close a loss, but I don't want to just, I may just leave it as is. If I go to Riot, Riot, we've locked in 2,988 without owning any shares, so I'm not concerned about Riot at all. Rocket Lab. So, I follow some companies, but I don't have positions in them. And I don't want to deploy all the capital to be in a stock that I'm not sure if I want to be in 2, 3, 4 months, right? I'm not sure yet. I'd like to know more about it. So I bought calls. It's a good way to control, abate your basis, right? Your cost basis. So if you think it's a good time to buy, but you don't want to fully commit, you get rewarded for buying it during that time. So $12.50 calls. So I'm currently up $30 on these. I bought them for 30. Oh no, wait, these are the calls. I'm sorry. So I'm pretty much doing the poor man covered call on this right now. So it's at $11. I bought two $10 calls. Okay, so these are the long dated calls that, look, I may actually exercise these by the time it gets to January. I may say, you know what, I want to keep these. But in the meantime, I want to pay off my premium because I don't want to buy them for more than, I'd like to buy them at the 10. But technically, if I exercise it now, I'm buying it at the 10 plus 225. So 10, 11. So at 12.25, I'll be buying them at 12.25 and it's at 11. So, I wouldn't want to do that yet. I'm up $40. I could just sell it, but what I've been doing is I just sell calls against it. So let's go to, I may actually just have it here. This is my random trade one. So trades that don't have their own individual folder, I put here, and you can see Rocket Lab right here. I bought it for call bought $10, $10 strike, 2 for 225, so it shows a 450 loss. I sold a call for, that's not right. That expiration is wrong. I sold them for November 1st. $12.51 for $30, $60. So now my basis on my premium is really $3.90. That's what I like to do. So I'm just monitoring this trade. Nothing crazy. SoFi. SoFi's been one that, you know, truthfully, I got caught with my pants down, honestly. You know, I truly believe this is, and one of the issues with selling options is that you get very confident when it's trading range bound. So when it's trading within a certain price, you get pretty confident with it. And so I fall victim to selling more aggressive premiums, right? More aggressive strikes. And I usually get caught underwater. So you got to just make sure you stay disciplined during, you know, we all knew that with the lowering the interest rates, this thing was going to blow up, you know, so I should have taken that into account. But anyways, I've got 1,000 shares at $6.78. So we're up about 4,000. But here's where I messed up. I've got one $8.50 call for November 1st next week. So I'll probably roll this one. It's at $11. So I don't think I'll be able to, I'm just going to roll it to $9, hopefully for a credit, and hopefully keep it within this year. $8 puts, these are just let run. I mean, this is honestly a home run trade here. $290, $80 credits, sold it on 9/30, close to a month and a half ago. Not worried about that. SoFi $10 puts. This is the one that I generated significant in the beginning. For some reason, they were going for, I mean, they were paying a good premium. You know, they were for December SoFi $10 puts. I mean, if we continue to reduce rates, which it seems like that's the plan, then, and, you know, especially with a Trump presidency, I know he's going to pressure the Fed to lower the rates. So this was paying 97, 110 I was able to generate. Could have sworn it was more. So anyways, they're worth about 61 now. So we're at a $200 profit, but I'll probably just let these expire. You know, I'm really not concerned about it at all. This $8 call, so I have the majority of my shares, $8 calls expiring January of 25, and then $7 calls January of 25. I'm gonna have to really do the math to see if it makes sense to roll it, but I'm gonna try. You know, I gotta take it. You gotta do all the math. And then I had bought a $10 call a while ago and been selling calls against it. I may sell this. I'm not too sure. But we'll see. Now, if I go to SoFi's been one that's been very good to me. Even though, you know, you can't get greedy. Even though I didn't capture much of the upside, it generated me a decent amount of premium, and I'm happy that I owned it. You know, so we're looking right now at $5,500 in premium generated. That's on 1,000 shares that my basis was $10.32. I think here it shows like $6 and change. So I'm not sure how Robinhood is calculating basis now, but 678, maybe it takes premium into account. That would be interesting if it takes premium into account. But anyways, even then, so $10.32. Because look, I sold shares at $6.50. Isn't that crazy? But that's how it was with this stock. You know, it wouldn't be able to hold 7 at one point. So anyways, it takes all these losses. You know, I took an $1,800 loss from there. So no, I'm sorry. This is what I generated, 1887. Yeah, so you did reduce that from the basis. $10.32 with all the premium. We're at $4.81. So a phenomenal a phenomenal play regardless. So, you know, whether I let the shares get called away or I decide to roll it, it's really just going to come down to cost. You know, how much premium that generates me. Even if it's really low premium but share appreciation, I'll add that into the mix. And it just has to be a reasonable percent return. You know, I when you get caught in these scenarios where the stock price is way higher than your strike, it's not necessarily a bad thing if you can generate a decent return with share appreciation plus hopefully generate some sort of premium. If you can generate something that's reasonable, you know, it's a really good hedge, because if the market goes to shit and that stock goes down, that's your hedge right there. And you may be positioned in a way where that call now expires worthless, you know? So I don't necessarily get upset when I'm underwater. I get upset, or I'm not upset, but I don't like the scenario when I'm in a position where I have to let go of the shares just because it doesn't make sense to hold on to them anymore, even though it's a company that I really like. Sure, I can buy more shares, but that's a different story. If I want to expand my position. TSLL, you know, this is a funny story. It's almost as if I hadn't learned my lesson with the original Tesla shares, right? So I bought about 800. I had bought 1,000. I sold 200 when it spiked because I thought it was going to correct back down. So I bought these shares because my Tesla shares, since I'm stuck at a 205 strike for December, I didn't have any upside on Tesla, and that was really bothering me. So I said, you know what? Let me buy 1,000 shares of TSLL. That will be my upside, and I'll let that ride. I sold calls on them, even though I wasn't supposed to, and I sold 5 calls on them. I own 800 shares, so I have about 300 that are unencumbered, and 3 of them are underwater, so I have $12 calls. Now, I'm not too concerned because the premiums are so good on this TSLL that I'll probably be above water within a month. But I just, you know, I'm not happy that I was caught, because the whole point of those shares was to now wheel them. Anyways, I've got 800 here. My base is $11.49. We've generated $1,300 in profit, mainly from just put sold. I had bought some $9. Look at that, $9 strike. Oh, but these are the ones that, these is a phenomenal play. This was during earnings last time. Generated like $1,000 off of that trade. Should have held on to these. Anyways, so our basis is $9.76. Not shabby. Where are we at here? We're at 38 minutes. All right, 38 minutes. I'm going to try to wrap it up. If you guys have any questions, start writing them in the comments so I can address them. Celsius. Celsius is pretty much the poor man covered call small account strategy. It's a really good strategy. You still get to wheel. Your capital outlay is not a lot. Celsius, you know, Celsius had a fall from the heavens from like $90 to $26, $27. And, you know, studying the PE of other companies and just the story of Celsius, it felt undervalued at that price, and it was really hard not to buy. So instead of buying and deploying, you know, $3,000 to buy the shares, I simply bought a call option, a long-dated call option for $25, and I'm just going to wheel it until that time. And then at that time, I'm probably going to exercise it, you know. But if it goes down for some reason, if it crashes, my risk is very limited as well, because I only paid $600. I didn't pay the $2,500 to have bought them at 25. So buying call options, while you do pay the premium, it gives you 2 really good options, which is it limits your downside and lets the story play out during that time that you bought, at which you can wheel to kind of sort of get your premium back, but it lets you kind of dip your toe in before you fully commit, you know. So it's a good strategy to have. I'm starting to incorporate it a bit more, especially with smaller trades in companies that I want to track and really understand. It gives me that ability. So This is up about $177. We bought it at a really good price. And so what I've been doing with it is just selling calls on it. So right now I sold a $34 call for November 8th, 34. So I'm feeling pretty confident on it. Pretty easy trade. Generated $300 worth of credit. Now, obviously, this is a lot of credit also because it was a roll. So at that point in time, it was a very aggressive trade. If we go to, where is it? I don't even think I have a Celsius page yet. It's a very small trade. Yeah, right here. So I bought it for $6.51. I sold it. I sold a $31 call for $51, and that got caught underwater. So I took a $244 loss, but rolled it all the way up to 34, and still for a premium because I sold it for $56 premium credit. So yeah, that's pretty much it on that play. I'll continue to just sell calls on it, try to get my premium back before I execute and actually buy them at 25, which is a phenomenal cost basis. And then lastly, let's see what we have lastly here. SoFi, Celsius, CleanSpark, Chipotle, $56 put. This is just, I love Chipotle. So I just had to start playing Chipotle. I'm a big fan of Chipotle. And I think that they are at the forefront of an automated restaurant because of the way they serve their meals, the way they've trained the consumer, and the food that they serve. I mean, what's to stop that from being completely automized? And they're at the forefront of it. So I think they're going to be doing some interesting things. They just lost their CEO to Starbucks. I think he was a good guy, but I don't know. I think Chipotle needed to kind of get a little bit more aggressive. Hopefully the person they hired does that. Look, I like Chipotle. I'd like to buy it at 56. If I see it correct at some point, I'm going to track it, but I'll buy it. I like this company. I love Chipotle. I eat that shit all the time. Intuit, Hims is another one I'm doing a Portman cover call on. You see how I have like little bricks? That's why I love that analogy, because that's really what trades are. If you're making 10, 15, 20% on every small trade, when you look at the big picture, that's 15, 20% returns. It doesn't change, right? And it's so much easier to generate the win on these smaller trades than it is to do it on bigger trades, in my opinion. So Hims, I bought at $16. I just bought 100 shares. At that point it was so cheap that I was like, all right, $1,600. I might as well just buy it. So I bought it. I have a $20 call, so it's a little bit under the water. That's fine. I have two $18 puts. These were paying very good premium. Actually, I remember they were paying, look at $195. I foolishly sold a few at $145. But it's always just deleveraging a bit. That's really the goal. Take profits, take them often. Don't keep snowballing everything. Even though my name is Snowball Hustle, sometimes you got to keep packing your snowball, but keep some snow for yourself, and then keep doing it. That's pretty much it. I've got some random SQQ $7 call. These are just small trades that I take. $3. I have 3 Walmart $80 calls. I think they're going to do very well with their earnings. Tesla Q, it was just a hedge in case it went down, $1,000 hedge. I have till December 20th, and Tesla's very volatile, so I'm not completely discarding these. Rocket Lab, these are the calls that we spoke about. That's pretty much it, guys. These are my positions. I'd like to completely get out of CleanSpark. I'd like to create a position to 1,000 shares in Hims, and create a position to 1,000 shares in Chipotle, and I'd like to get to 1,000 shares in Celsius. So that's pretty much it on my portfolio. Real quick on the rules, we're continuing the segment of trading rules. These are the rules that we currently have right now. If you want to go into detail on them, I go into detail on each particular one in previous podcasts. So if you want to hear that part on a specific one, just go back on however many days back we are. So we're on trade number 5, or rule number 5. Now, again, these are rules that have worked for me. So if they don't work for you, or you don't like them, or you disagree with them, don't use them. I'm just sharing with you what I've learned and what's been useful. So this one is use macro news to confirm technical and fundamental stock trend. So this one's very important, because the way I read this is, pretty much don't be an ostrich and put your head in the sand and just look at technicals and fundamentals, because companies don't exist in a void. You have to understand what's going on with the macro news, right? Like, for example, I'll give you a good example. We have a pretty big conflict going on with Israel and Iran in the Middle East. And while you don't think it does, it really does affect us, because each country is allied with individuals that could make this a bigger deal than it has to be. That's a macro event, right? And so it would be smart to hold a portion of your portfolio in cash, because every time there's an escalation of war, the market dips a bit, and the market takes that into account. Is that going to drag us into a war? What's that going to do? Or even the elections, when you know that the macro news is a bit shaky, be cautious and use that to then confirm whatever it is that assumption you have technically or fundamentally. Don't make it in a void. That's why it's important to keep track of news, even though you're not a news person, or you particularly enjoy keeping track of politics, because who does? But when money's on the line, it's an edge, and that edge is very important. All right. So that's pretty much it on the rules. If you guys have any questions that you would like me to answer, let me know. I also I have it on my page on X, but I just wanted to reiterate that I do take private courses with individuals. Pretty much the way I do them is sort of like I'm teaching my dad or my grandma or my grandpa how to trade options. And whether you need to start on floor 0 and we need to cover what is an option, and you need to understand it, not just memorize it, but understand it. We take it all the way from there to how do you generate X amount of premium in the least aggressive way for a retirement or whatever it is, right? So we really just hone in on you. So if you have any interest in doing that, you can just shoot me a DM on my X account. Otherwise, I do these lives and I go through things in detail. These are all free. I do it live, usually once or twice a week. Follow me, please, on X, and subscribe on YouTube. That way you can, when I post these trades or when I do my portfolio review. Transparency is the most important thing, because I think that when we are transparent, we truly learn. There's no point in making this more glamorous than it is, or more aggressive than it has to be. I'm just going to show you what it is, and you decide whether it's for you or not, or you want to follow along or not. Having said that, guys, enjoy your Sunday. I will see you guys next week. Market opens. We have basically a week before elections, so do expect it to get a bit I don't want to say choppy, but I anticipate, once a Trump presidency is fully baked in, which it seems it will, I believe we're going to see a rally, just mainly because of his claim that he's going to reduce corporate tax to 15%, which that's billions of dollars added to every large company's bottom line. So I think markets are going to start to price that in. So look, just be ready for that. I think it's going to be good. That's pretty much it, guys. Thank you so much. Please subscribe, and I'll see you guys next time.